While all eyes were focused on the Enron scandal in 2001, an even bigger bomb was being assembled in the offices of WorldCom in Clinton, Mississippi. Bernie Ebbers, a former physical education teacher turned CEO, had built the second-largest telecommunications empire in the United States through a simple strategy: buy, grow, and repeat. But behind the impressive numbers and aggressive acquisitions, WorldCom was hiding the largest accounting fraud in corporate history: $11 billion. That number is so astronomical that it makes Enron look like pocket change. This is the story of how a company that controlled a significant portion of internet traffic worldwide managed to deceive investors, auditors, and regulators for years. A story of greed, desperation, and accounting manipulation that would forever change how we view corporate governance. The big question we need to answer is, how did a telecommunications company manage to hide $11 billion in fake profits? And why did it take so long for anyone to notice? Bernard John Ebbers was not your typical Wall Street executive. Born in Canada, he moved to the United States and worked as a high school basketball coach and physical education teacher. His entry into the business world came almost by accident when he invested in a small, long-distance telephone company in Mississippi in 1983. That company was called Long Distance Discount Services, later renamed WorldCom. Ebbers had a vision: to challenge the telecommunications giants through aggressive acquisitions and competitive pricing. Throughout the 1990s, WorldCom grew like a snowball rolling downhill. The company acquired dozens of competitors, including the massive MCI Communications for $37 billion in 1998. Each acquisition was financed with debt and company stock, creating a house of cards that seemed unstoppable. Ebbers became a celebrity in the business world. He was featured on magazine covers, gave lectures at universities, and was considered a visionary who had revolutionized telecommunications. Wall Street loved him, and WorldCom stock soared to astronomical heights. But there was a dark secret behind this meteoric rise. The company was growing so fast that it was becoming impossible to integrate all the acquisitions efficiently. Costs were spiraling out of control, and profit margins were shrinking. The telecommunications market was becoming saturated, and competition was intensifying. The pressure to maintain growth and meet Wall Street expectations was becoming unbearable. And that is when the fraud began. The WorldCom fraud was not a complex scheme involving derivatives or special-purpose entities like Enron. It was much simpler and, paradoxically, much more audacious. The scheme was orchestrated primarily by Chief Financial Officer Scott Sullivan, a brilliant accountant who found a way to make expenses magically disappear from financial statements. Here is how the trick worked. WorldCom had enormous operational costs, especially what are called line costs, the fees the company paid to other telecommunications companies to use their networks. These costs should have been recorded as operational expenses, reducing the company's profits. But Sullivan had a different idea. Instead of recording these costs as expenses, he classified them as capital investments. In accounting terms, this means that instead of reducing profits immediately, these costs would be spread over several years as depreciation. Imagine you run a pizza restaurant. Every month, you spend $1,000 on ingredients. Normally, you would record this as an expense, reducing your monthly profit. But what if you decided to call these ingredients kitchen equipment and spread the cost over 5 years? Suddenly, your monthly expense drops to just $200, and your profits appear much higher. That is exactly what WorldCom did, but on a scale of billions of dollars. Between 1999 and 2002, the company transferred approximately $11 billion in operational expenses to capital investments. This accounting manipulation allowed WorldCom to report profits when it should have been reporting losses. The most shocking part? This was not done through sophisticated software or complex algorithms. Much of the manipulation was done manually, with simple journal entries that moved money from one account to another. By 2000, the telecommunications bubble was beginning to burst. The internet boom that had driven demand for WorldCom services was slowing down, and competition was intensifying. The company was struggling to meet the growth expectations it had created. Bernie Ebbers was facing a personal crisis. He had borrowed hundreds of millions of dollars using his WorldCom stock as collateral. As the stock price began to fall, banks were demanding additional guarantees. Ebbers was trapped in a vicious cycle. He needed the stock price to stay high to avoid margin calls. But the company needed to show profits to maintain the stock price. The pressure was immense. In board meetings, Ebbers would pound the table and demand that his team find ways to cut costs and increase profits. "We have to make the numbers," became his constant refrain. Scott Sullivan and his accounting team were working around the clock to find new ways to manipulate the books. They began making increasingly aggressive adjustments, moving larger and larger amounts from expenses to capital investments. But the scheme was becoming harder to hide. The company's internal auditors were beginning to ask uncomfortable questions. Cynthia Cooper, WorldCom's vice president of internal audit, was particularly persistent in her investigations. Cooper had noticed discrepancies in the financial statements that did not make sense. Why were capital investments increasing so dramatically while the company was not building new infrastructure? Why were operational expenses decreasing when the business was clearly struggling? In March 2002, Cooper decided to conduct a secret investigation. What she discovered would bring down one of America's largest corporations. Cynthia Cooper knew she was walking into dangerous territory. As vice president of internal audit, she had access to WorldCom's financial records. But she also knew that questioning the accounting practices could cost her job. Working at night and on weekends to avoid detection, Cooper and her small team began analyzing the company's capital expenditure records. What they found was shocking. Billions of dollars in expenses had been improperly classified as capital investments. The amounts were so large, and the justification so weak that there was no doubt this was deliberate fraud. Cooper faced a moral dilemma. She could report her findings to Scott Sullivan, the CFO, but he was likely involved in the scheme. She could go to Bernie Ebbers, but as CEO, he was ultimately responsible for the company's financial statements. Instead, Cooper made a courageous decision. She went directly to the company's audit committee and external auditors at Arthur Andersen. Her report was clear and devastating. WorldCom had been systematically manipulating its financial statements for years. The reaction was swift. Arthur Andersen, already under scrutiny due to its involvement in the Enron scandal, immediately launched its own investigation. Within weeks, they confirmed Cooper's findings. On June 25, 2002, WorldCom announced that it had discovered accounting irregularities totaling $3.8 billion. The company's stock, which had once traded at over $60 per share, collapsed to less than $1. But this was just the beginning. As investigators dug deeper, they discovered that the fraud was much larger than initially reported. The final tally would reach $11 billion, making it the largest accounting fraud in corporate history at that time. Bernie Ebbers resigned in disgrace. Scott Sullivan was fired. And WorldCom, once the second-largest telecommunications company in America, filed for bankruptcy. The aftermath of the WorldCom scandal was swift and severe. The FBI launched a criminal investigation, and federal prosecutors began building cases against the company's executives. Bernie Ebbers, the former gym teacher who had built a telecommunications empire, was convicted of conspiracy, securities fraud, and filing false documents. In 2005, he was sentenced to 25 years in federal prison. one of the longest sentences ever imposed for corporate fraud. He served 13 years before being released in 2019 due to declining health. Scott Sullivan, the mastermind behind the accounting manipulation, cooperated with prosecutors and received a 5-year sentence. Several other executives were also convicted and imprisoned. The human cost was enormous. More than 20,000 WorldCom employees lost their jobs. Investors lost over $180 billion in market value. Pension funds that had invested in WorldCom saw their assets evaporate, affecting the retirement security of millions of Americans. But perhaps the most significant impact was on corporate governance itself. The WorldCom scandal, combined with Enron and other corporate failures, led to the passage of the Sarbanes-Oxley Act in 2002. This landmark legislation fundamentally changed how public companies operate. It required CEOs and CFOs to personally certify their financial statements, established stricter oversight of auditors, and created new penalties for corporate fraud. The law also mandated that companies establish stronger internal controls and whistleblower protections, directly inspired by heroes like Cynthia Cooper, who risked everything to expose the truth. So, how did WorldCom manage to hide $11 billion in fake profits? The answer is both simple and terrifying. Through basic accounting manipulation that should have been caught by multiple layers of oversight. The fraud succeeded because of a perfect storm of factors: aggressive growth expectations from Wall Street, weak internal controls, compliant auditors, and executives willing to sacrifice integrity for short-term gains. But perhaps the most important lesson from WorldCom is this: fraud is not always sophisticated. Sometimes, the biggest crimes are committed with the simplest methods, hidden in plain sight within the complexity of modern corporations. The WorldCom scandal reminds us that in the world of high finance, the difference between success and fraud can be as simple as moving numbers from one column to another. And when that happens on a scale of billions of dollars, the consequences can destroy not just companies, but the lives of thousands of innocent people who trusted in the system. Today, as we face new corporate scandals and financial crises, the ghost of WorldCom serves as a constant reminder: eternal vigilance is the price of corporate integrity.